All right. What is it? Wednesday, everyone. Thank you for joining us on this almost lunch hour. I guess if you're on the East Coast, then it's lunch hour time frame, where we're going to talk about being proactive versus reactive, specifically in the financial sense, and seeing a lot of familiar names. And on here today, some of the examples that I'll give will be right in alignment with some of the things that might be opportunities for you guys to continue to develop and grow as well. So I'm going to go ahead and share my screen now. I'll do my best to try and add people if they pop in the waiting room as well. So let's go ahead and share. All right. The topic for today, proactive versus reactive. Five financial shifts for helping companies use to build clarity, confidence, and long-term stability. And this is a lot of what we do here at Light Consulting. Some of you know me in various capacities. But at Light Consulting, our goal is really to make business light. And how we do that most often is either through strategic or planning or through financial consulting, because finance is a piece of our business that can be really heavy if you don't have an understanding or know kind of where things are at. So that's really what we do here at Light Consulting. And this is my incredible team that makes me look good on a daily basis. So I'm going to use some examples here today throughout the webinar, and those are just for illustration purposes only. You'll have different results, of course, if you utilize some of the tools and understanding. So just disclaimer there. All right, let's jump into what we're here to talk about today. So when I think about, let me just sneak back for a slide. So I know we're all off camera, but I also want you to think about what are you experiencing and feeling? Because although we have what we're going to talk about is how do we use data to kind of understand and to make decisions, but also we also have a big piece of our leadership in organizations that come from the way that we feel and the way that we experience the world. So I want you to pause for a moment and think about what am I feeling about my organization, specifically in the financial realm? Are we not meeting our goals? Are we falling short? Am I a little uneasy about the future and the unpredictability of sales or about cash flow, those types of things? Because as you think about that, you want to try and grab some of those things. So we're going to talk about all of that. So, which one of these five facets really resonate more with you and kind of the opportunity that you have in front of you, the problem that you have in front of you to solve? And then as we move through these, you can be like, okay, this one I want to pay really close attention to. I know sometimes on webinars we get the opportunity to be distracted by other things, our devices or second screen, those, but I want you to perk up when you hear cash if that's something that's exciting or something that is an opportunity for you to solve. All right, so the core problem that we are identifying here, that I've identified in working with organizations, is that we live a lot in our world in reactionary mode, and that's not just in our business. That can happen in our overall world. And part of that is because we now have so much data, so much information that we can't process it all. So therefore, we react to things versus respond to things. And often we think we need to reinvent things because we got new information versus re-solidifying the plan that we already had in place and just maybe reorienting or pivoting or making one notch different in that plan that we've already had. So the core problem here that we're feeling and experiencing as business leaders is being reactionary versus proactive. So what does reaction sound like? We'll deal with that next month. I think we're fine. CPAs handle that, our accountants handle that. We'll figure it out. Cash is tight, but it always works out. I get a lot of that feedback from the business owners that we deal with. And reaction, what it feels like is really like, I don't really know, avoiding financial reports, like not even looking at a growth that might feel hectic, or what I even get to experience, even though, because although I teach this stuff, I also don't have to apply it in my business. And what we experience in our business is what talk to about break gas. Like we have too much work break, we have not enough work gas, and kind of this break gas piece of it, and kind of smoothing out those waves. And then those are just some things that we are going to talk about today to try and undo the reactionary and getting to proactive. So, the truth about healthy companies is they operate differently. They don't wait for fires. They try to predict those fires, and they build systems before there might even be smoke. So there's three kind of things here that I wanted to talk about is revenue versus stability. So a lot of the people on the call today are heavily involved in the construction world. And I have some examples today that I'm going to be sharing that are construction specific. And for those of you who are in that world, you know about the waves roller coaster that can be when a project pushes or when things shift, and how do we kind of smooth that out. An organization that I was working with, that I am working with out of Albuquerque, we talked about, we were using the analogy of the waves and swimming specifically in the Pacific Ocean. A couple weeks before that, I was in Mexico, actually on the Caribbean side versus the Pacific side. But on the Pacific side, if you've ever been there, if you're going to enter the ocean, you have to get through the waves. And those sometimes are some really big waves. And what we were talking about is the instability that comes through getting through the waves and getting to a point of stability where where the water is smoother. We're going out to smoother waters. So this is where we think about, rather than thinking about just straight up revenue, is how do we create stability in our revenue? The other thing that we're going to talk about is growth is not equal health. So growing for growth's sake is not always the best the best strategy. And all of you know this, all of you who have been in business for a while know that growing just to grow is not good. Bottom line, sometimes we can do double the top line and still make less money. We've probably all experienced that. And then profit, having a strong bottom line doesn't always mean that you're clear on what you are working for and where you're going. So those are some things that we're going to address. Now, these shifts that we're going to talk about, these 5 shifts that we're going to talk about, are listed here on the screen here, and how they impact your business. So lagging versus leading indicator, getting from looking at past financials to looking at the future. We need leading indicators. Bank balance versus operating system. So a lot of time businesses come to us and we call them accounting via bank balance. If my bank balance is higher this month than last month, then it must have been a good month. That's not a terrible way of doing it, but it's also not the best way, as you want to try to grow and develop your business. The next one is annual budgeting, that stagnant budget versus a dynamic roadmap. And we're going to talk about that. And I'm going to give you an example specific to the construction world that I've been working, mentally working with. Now I got to physically work with Excel and trying to get that emotional versus financial leadership. And then my people are right to the side here. And then we have short-term survival versus long-term stability. So really making those, I guess I can't speak to everybody that's on the call today, but for the majority all the ones that I'm familiar with, none of you work in publicly traded companies. So you're not chasing quarterly earnings. You're really focused on that long-term stability. So what is lagging versus leading? So a lagging indicator is last month's P&L or profits or last year's tax return. It's that past information. And when we talk about the role of the finance department, we talk about there's people in the finance department that are compliance driven, and those things are very necessary given our current rules and regulations. So we have to file sales tax on time, we have to file our taxes on time, we have to do all those things. We have to know that. And then that person in that higher level role, that CFO, and some controllers can play this role too, is what is the forward looking thing? Because the past is in the past, so we can't change that. But really, what is that forward looking piece? And how do we shift that mindset to think about those forward thinking pieces? So, this is a couple examples of things that are forward looking that should be a piece of your leading indicators. So again, if we're just reviewing the P&L on a monthly basis and that's coming out either 2 or 3 weeks after the month has already ended, it's just historical information. And the value in having historical information is one, it keeps the IRS off our back or all of those regulatory agencies. But the other value is specifically for those of you in construction, what can we learn from that? Or because if we had a job that maybe went sideways on us, how do we take that information and not do it again? Would be the most value that you're going to get out of your lagging indicators, such as a profit and loss or a job cost, job report on a specific job. So these 7 or 6 things that I put here are really important as we think about leading indicators. So we do this for certain for every organization that we're in what we call cash management mode, which is when we really should do it for all of them, but those who cash is a little bit tighter, maybe because of the seasonality of their organization, or they just are in that situation. 2025 wasn't as good as a year as they were hoping, so therefore we have to manage cash going into 2026. So we do a 13-week cash flow forecast. And we have a worksheet that we actually got from QuickBooks Online conference that we went to a couple of years ago. So we've modified it since then. But it really gives us a really good look of what is coming in and going out in the next 13 weeks. And we've been able to do that with our construction companies too. And what it does is it helps those, specifically the construction companies, understand the importance of getting your billings out on time and collecting your payments out on time so that you can pay your vendors on time. Pipeline conversion rates, that's more sales related. So when we think of a leading indicator, sales is one of the biggest leading indicators, but it's not a sale we invoiced it because that's now lagging because it's data that's in there for the past. A leading indicator on the sales pipeline would be we have to bid 10 jobs a week to be able to get 2 jobs a week. And then you can equate that to revenue, or we have to bid let's just say, because where most of us live, I don't know where everybody lives, but most of us live here in the Midwest. So from a bidding cycle, now is probably the hot button time for any work that's going to be performed and concluded well, not even concluded, but performed in 2026. So probably about April of this year, you're going to know with good certainty if you have construction jobs on what your 2026 is going to look like and end like. Because if you haven't bid it and been awarded it by the end of April, the likelihood that it comes into your cycle in 2026 is low, right? So we can do that. And whether you do that in an Excel document, your wins, losses, or you keep that in a CRM, that's all great stuff. Gross margin by product line or division. So one of the companies on here has 4 different product lines, and knowing those gross margins by product line is super important. So we can know which levers can we push and pull on. And then if you're in construction and development, you have your development margin, you have your GC, your general contracting margin. And then in our organization, we are a service-based business, which actually isn't that different from construction, and we're exchanging time for money. So what is my margin? What am I billing a person at versus what is it going to cost me is important. Our burn rate is also super important. So that's like we have X number of dollars contracted now to date. So we have future revenue. That's a leading indicator of how we're going to be. How quickly are we going to burn through that? So sometimes we can get awarded really big contracts, and those contracts might take us 24 months to burn through. Or we could have, so let's just say that's a $20 million contract. Let's do 24 because that's easier math. So $1 million a month. It never works out that way, by the way, but let's just say that it did. So we have 24 million in the next 24 months, but we need 100 million a year to break even would be information that is helpful in that burn rate. And I'm going to share with you a worksheet after a little bit here that's helpful. That revenue per employee is also a leading indicator. So how we do this in our organization is everybody's got a goal from the billable hours. So every week you need to spend X number of hours in billable time so that we come to the end of the month, our revenue is extremely predictable. So if you're not hitting your hours, therefore, then we're going to have dips in our revenue. So that's just an example of something in a service-based business that's important. And then the last one is that cash reserve runaway. So again, cash forecasting is super important for a lot of businesses that are managing cash. So leading versus lagging. Hmm. Your P&L tells you where you're unprofitable last month, but it's already too late. Again, you're often reviewing those 3 weeks in, 2 or 3 weeks after it's done. So one of the things that I want to say out loud is if your results, because you shouldn't not look at your results, because that's when other people start to take your money, is if you're not looking at your financials. But if you're looking at your results, what I want you to gut check is, did that surprise me? Because you should not have any surprises. Like if you missed on your revenue versus your projection or your budget, you should know that even before the financials come out. So if your financials come out and you were surprised by something, that's a good reflection point for you to say, how do I stop that? How do I stop being surprised by something? Either did I not budget appropriately or project appropriately? How did I not track that information throughout the month so that when the financials came, it should just be like yep, this is exactly what I expected. In the seasonality work that we have here in the Midwest, maybe January, February, March are lost months. And as long as it was close to the loss you predicted, then we can sleep okay at night. It's when things get kind of run away from us that we need to have those conversations of what are we actually measuring and why was this a surprise? So there's a couple healthy companies know what their cash will look like 90 days out. It should never be like, oh, we have payroll tomorrow and we don't have enough cash in the bank. We should be planning for those things ahead of time. Hiring is also a thing for a lot of organizations. Their human capital is their greatest cash draw, if you would, for payroll. So making sure that we're understanding what does that look like on a regular basis and what are we hiring for and what does that look like? One thing that I'm going to just pivot a little bit there is every time that a person leaves the organization now, I want you to ask yourself, what is the right new role for this company? And why that's more important now than it was 5 years ago is because AI is moving at a pace that will be interesting to see if our society and our energy drain can even match. So when I think of our organization, last year at this time we had 14 employees. Right now we have 10, who's only 50% time and one who's not an accountant. And we did more work for year end this year than we did last year. And a chunk of that is attributed to AI and how we're utilizing that to get our work done faster. For an example, so thinking about that pricing, that's always a piece of it, stable versus what work is stable versus being pushed out. And if you're in construction, you know all about that. And then whether debt payments will create constraints. So again, at that forward thinking mindset, we need to think about that component as well. Is there an opportunity to restructure our debt so that those payments make sense for us or accelerate those payments in good times so that we don't have a strain in the future? Here's an example of a 13-week cash flow. We grabbed it from the internet versus using ours for client data, but this is very similar of what it looks like. We just have our operating cash and then ins and outs that go on a weekly basis. So you can see kind of that opportunity. We actually get this information from QuickBooks Online. It gives us the chart. It's not great from a flexibility standpoint, but an example of something that you should do is that. Here's another example of a construction scorecard. And why employee satisfaction is on there is if you guys are in the business, you guys all know how hard it is to get customers. So that's why that one is on there from a that's super important is to have that client satisfaction so that they come to you for their next project and you don't have to go to the open market and bid because that market, the margins are versus a client relationship where they just call you and say, "Hey, can you build this thing for me?" So that here's an example. I know we have a lot of True North Steel people on here, and you guys do have a dashboard that has a lot of leading and lagging indicators on it. That's super helpful. So the first thing, going from lagging indicators to leading indicators. So the first and simple thing would be build a simple 13-week cash rolling forecast so that you don't get surprised on Friday when payroll's coming out. You knew what was going to go on there 13 weeks ago. The next one is bank balance thinking versus operating a financial operating system, the illusion of the bank account. So, and again, I know I'm hitting heavy on construction, but that seems to be that. I have a property manager on here too, and what you can see in these in if you're been in business long enough is the cycle of the bank balance, if you will. So in construction, when we get our pay apps collected, we have a bunch of money in the bank and then we pay all our subcontractors, material suppliers, and it goes down. Same in property management, we collect 1 day a year. Same with accounting services. For the most part, we collect one day, I said 1 day a year, 1 day a month. You better not wait all year to collect on your AR. You're gonna have all sorts of cash fund things to struggle through. But once you get used to that cycle, then you can plan those things accordingly. So healthy companies, this is something that gives, so for those of you, if any of you are in that space where you have anxiety or just a feeling around cash reserves, these are our recommendations for that. So we have our operating account that does the roller coaster, maybe on a daily for sure, on a weekly basis. And then we have a tax reserve account. So we're setting aside money in that tax reserve on a regular basis. So for some of our higher taxpayers, we're doing that on a monthly basis. And some of those that maybe have some different fluctuation, we do it on a quarterly basis. And that account just sits there. And then if we get to the end of the tax return and you only owe 50,000 versus 150,000, then we can move that other 100,000 into one of the other accounts. Like, could it be an owner distribution that's then reutilized for an owner investment in X? Is it something that we need for capital expenditures? And then those emergency reserves. So 3 to 6 month operating in cash or liquidity. So that could also be a line of credit is one thing that we talk about consistently with our clients is making sure that you have 3 to 6 months of liquidity in your organization. Again, that'd be great if it's in a cash balance. If it includes your line of credit, that's also okay. So immediate action step for the illusion of the bank account is create separate accounts for those kind of three different things. And like I said, it reduces the anxiety because you have this reserve over here versus I have experienced this for the last 20 years. Less for me. Now that I'm a business owner, I get to experience it. Well, I do the math, so I don't actually experience it the same as my clients. But when the CPA emails you on April 14th and says you owe six figures to the IRS and you got to write a check tomorrow, like I know we don't have the cameras on, but I guarantee that if you are a business owner, you have gotten that email and you're like, oh, what? Now I got to come up with that money. So that's one thing that can help with that anxiety. All right, annual budgeting versus dynamic financial roadmap. So this is the one that I think is most probably helpful in what we call the dynamic world that we're living in, where things are shifting continuously, probably every week, if not every month. But the stagnant budgets that we used to do, just there's value in them the value in a budget is it gives leaders of those divisions understanding the fence, if you will, of the playground in which they can play. So if I do a budget and I know I have the opportunity to hire +2 staff members or to spend $10,000 on professional development within my department, or this much in travel, then it's a lot easier to measure towards than to just be like, no, we're not doing budgeting. So again, like the annual budget process and the results that people have is a good process to go through, but let's not just say that's it and we just budget in the fall and it is what it is, January through December, because you're not dynamic enough in that case. So the budget versus the roadmap, the budget stuff like done once a year, forgotten by March, rarely revisited. I don't know. Sometimes I think they are revisited on a monthly basis, but for all of you guys who have projects push, then it's going to look different. As soon as that project pushes, your budget's going to be wrong. And the client that I was with yesterday, they had a project that was supposed to take off in November of last year. It still hasn't gone. So they missed their top line number in January by over 50% because that was a really big project or is a really big project, just not hitting yet. So now, therefore, their whole year is wrong because they're stagnant budget versus those 12-month rolling roadmaps and the scenario planning and stuff like that. Hiring forecasts, you guys, a lot of your organizations do that already so that they can plan and when those people are going to be coming in. Capital budgeting is often for a cash need because we have to pay for those things, whether it's through debt or through cash needs in the bank, and then debt reduction strategy. So all five of these kind of play into what does that roadmap look like? And these companies ask, what are we building? What does it cost? What does it require? What if what breaks if our revenue dips by 15%? So these are great questions that you should be asking your organization or asking yourself so that you can really kind of think about what happens and what is our contingency plan if ABC. And why that's so important again is because if we know what's going to break, if we don't hit our numbers, then we know, and then when we have that, oh my gosh, last month we didn't hit our numbers, anxiety, we can say, okay, we planned for this. It's okay. We have a plan for this. Just like when we think about other emergency situations and people who do really well in those situations and people who maybe don't handle those as well, those who do it really well have planned for it. Like if you've ever been unfortunate enough to have an medical emergency situation in front of you, those EMTs are calm, they're confident, and they know exactly what to do because they have practice. And the same thing in our business. If we have a dip or a project pushes, we should have those conversations now so that we know how to react to them or respond to them in the future. One of the examples of this is mixed use development project that I have going. And I like to live in rose colored glasses world that everything is going to work. So this particular project is a mixed use project. It's got 25 residential units and about 12,000 square feet of commercial space with underground parking. So best case scenario is that all of them sell within the first 24 months of that building being built, and our return on equity is almost 2x, and we return a profit of 2.2 million. So that's great. So I can go sell that all day long. But Mr. Banker Man and any of the investors want to know, okay, so if it's not all rainbows and sunshine, where are we at? So the one thing that I think if you haven't done this, that you need to do this is what is your break even number? So from a sales perspective. So if you're in the construction industry, obviously you have to, or even any industry, you have to use your margins and your estimated margins because and margins can shift, and I understand that. But let's just use what we historically have done on margin. Let's just say if we're a general contractor, we have 8% gross profit on margin. So then we got to know, okay, so if I have 8% gross profit on margin and I know what my overhead is because I did that stagnant budget, that tells me I have this many people and I have to pay this much rent and I have this much in insurance and all those things. So I have $1 million to cover in overhead, then I can really easily, and this is where your high school or ninth grade algebra comes in place. We're finding for Y or X, and that would be top line, given that we have all the other variables that we can use and assume. So break-even analysis is one of the most important things that you guys can do is to say, okay, how bad can it get before we bleed, basically, is how I like to think of that. So in this particular case, if, as long as we sell 20 residential units and 75% of the commercial units, then we have zero profit. That's our break even, but the equity would be returned. And in this case, when I'm asking people to invest in a project, the number one thing that people want is their money back. Like, yeah, I'm taking the risk and hoping to almost double my money, but at the end of the day, I want my money back. So that's the break-even analysis for us on this particular project. And then the worst case scenario is that we only sell half of both the commercial and residential. And then if we take option one and convert those to rentals, we have an annual bleed about $50,000. So the investment group needs to know that. And then if we don't convert them and we just hold them hoping that they will sell, then we have an annual bleed about 250,000. So that's good information to have because then at the end of the day, we get to make that decision of which one are we tolerant of and where will we go when this benchmark isn't hit. So that's super helpful on this roadmap piece is we've already done it. So the other thing, actually, I don't know. Okay, so I'm gonna pop out of here because before this action step, I want to show you a worksheet that I threw into Claude yesterday. So this is we call this the master pay tracker. So those of you in construction might see some of this familiarity. It's kind of like a G703, but it's modified because we're doing development. So there's a whole construction piece of it in there as well. So yesterday in anticipation for this conversation and knowing that I've been wanting to build this, but time is not my friend, I threw this into, we have this document. We have these 5 development projects going on in various parts of the country. And in these projects in development, if you're in development, well, whether you're in it or you are a cog in the wheel, where you supply products or materials that go into construction development, you know that development phase is funny. Like to get permits, depending on where you are, and all of these things, it can go from 90 days to 36 months. It just is all over the board, depending on where you're at. So what I wanted Claude to do, Claude is an AI software that we just started using and we just get to see so many remarkable things. I actually kept my Claude conversation up here to show you kind of the process that it went through. So I just asked this prompt, can you modify this? So that we can have the input cell for each project start month and update it when the project, in case it pushes and it updates all the tabs. And I didn't even actually read all of the commentary that Claude had. I just wanted the outload. So I uploaded that and I came back 10 minutes later and then it has an Excel sheet for me to download. And what I wanted out of this was I wanted to be able, Burlington's on track, Northport. This was supposed to start in January of 2025. I mean, we took down the land in December of 2024, but the construction still hasn't started on this project. So we have construction as of January. That's not going to work. So if I wanted to push this, and this is where it's really fun to see. So we're here. What month are we in? We are in March next week. That's so crazy. Okay. So March, this is our total billings, if you will. This is our revenue for all our projects for March with a development division and a construction development. So let's remember 2,326,000. So, but I'm going to go to Northport and I'm going to shift this to 2026 because it really hasn't even taken off yet. And now it updated all my numbers here and it updated my number here. So this number, 2,300,000 and some thousand, was going to be my billing, my revenue number for March of 2026 because that project pushed It's now 1.4. So the dynamics of having a full look at something like this is pretty powerful. And the fact that I didn't have to actually do this was already created and it has bell curve for construction and all of that stuff in it. I'm able to say, okay, so knowing that what we know now, March through at XYZ date, we're now operating, and let's just say for discussion purposes, this company needs $2 million in monthly revenue to cover its overhead because we've done that break-even analysis. We're short, right? And because we should know this information 3 months ahead of time, we would know that 3 months ahead of time. So then we can make decisions. Okay, what does that mean? Does that mean we have a line of credit till we can get over this hump and get into September when we're plus $2 million on a monthly revenue perspective? Or what are we going to do? So then we can make those decisions in that. So just wanted to share some of the power of planning that can help with that, specifically when it comes to construction projects that push, because there's a lot of people in here that feel kind of, well, reactive to that part of the industry when things push out. Again, communication with the client is a big piece of that. So, immediate action item on this is take some time to answer these questions. What does our business look like for the next 24 months? Revenue supports that, margins that support that, and cash that supports that. So, if you haven't had those discussions, I would encourage you to do those real quickly. It will help you sleep at night, knowing the plan. All right, the next one is emotional or personality based versus database decisions. So the world is split, and I know this because I'm certified in Myers-Briggs, and one of the components of the Myers-Briggs personality assessment is how we make decisions, thinking or feeling. Those who prefer thinking, they use logic and data and objective truth to come to a conclusion and a decision. Those who prefer feeling enter into the situation, kind of assess it, and then make a decision with that. And you can often hear leaders say, or business people say, I feel like we're doing well, or I think that we're doing well. And both of those are fine. That's a natural response. But what if we just knew, like, I know we're doing well, or I know we hit our numbers, or I know we didn't hit our numbers, and here's the plan to fix that. That's how you go from reactive to proactive. And it's really the secret is in the data. So as you continue to mine data and have data, and again, garbage data in, garbage data out, so keep that in mind. But really, that's how we make really powerful decisions and kind of lower that anxiety in this reactive world that we have. So, those are just some examples of things that some businesses operate on. And really, those healthy companies have that break-even revenue number. They know their contribution margin with certainty. In accounting, full disclosure, there can be some manipulation in that, and we don't want that. We want it to be consistent and do it the same way over and over again so that it's predictable. Consistency is predictable. Customer acquisition costs and how many on that side, even when I think about it, is how many proposals do we have to put out or estimates do we have to put out to get to a yes? And then what does that equate to in revenue? And the more data you capture there, the more rhythmic it can be. When I did my internship with Northwestern Mutual, they had a 10-3-1 system. It was 10 phone calls, three people will answer, one meeting will get set. And then you'll have 10 meetings, three people will do what they call a fact finder, so let you get to know them personally. One will be a client. So I knew that I'd have to make 10 phone calls to have three people answer to set one meeting, and I'd have to have 10 meetings to have one client in that case. I quickly learned that I had a better ratio with my warm market. And when it got to my cold market, then I said, no, I don't want to do this anymore. So that the 10-3-1 actually worked, but the predictability in it, then it came to something that I can focus on. This is where we go back to the first concept of leading versus lagging. Not I made 100 phone calls, is I have to make 100 phone calls a week or a day to be able to get to the numbers that I want. And now the touch points might be different, but phone calls still work really well. Okay, so the next steps that we talked about here is that break-even analysis that showed up a few different times. The current contribution margin, so really knowing what your margin is on projects or on engagement. So for us, we're exchanging time for money. So I need to know, okay, we're billing X if it's on a retainer that allows for X number of hours. If we go over the hours, then we're eating into our margin. And then if we go under our hours, then our margin is increased. But we need to know that going into the project, and then we have either gain or fade on a regular basis, and doing that mathematics on a regular basis. So if you're doing so for us, our contracts are usually a year and it's a set amount per month. And then we have a scope of work to do that. So we do what we call the profitability analysis on a monthly basis. So we can see by client based on the time that we spent with them, are we profitable or unprofitable? And we have that last month, the last three, and then a trailing 12. And why that's important to us is there could have been something in that last month that made it spike in hours or a decrease in hours, so then increase our profitability. And we want to be able to understand that because we do annual contracts, was that just something that happened to come up versus something that is regularly. And if we have somebody that's regularly below our required gross margin on our pieces, then we need to have that conversation with the client is either we're outside of either we didn't understand the scope of work, and then in construction, this would be a change order, right? We didn't fully understand the scope of work. Maybe we missed some, if we just missed something like we should have guessed X or we should have known X, then it's on us. But if it's like, okay, we said the scope of work is Y and you've added on ABC, then we need a change order, if you will, or we need to increase our fee for services, or do you want a one-time billing for that? And then we really realign with the scope of work here. So that contribution margin, looking at it when you bid the project or when you go into the engagement is important. And then checking it regularly to see are we still in line with that is also important. And another one that's really easy is revenue per employee, making sure that it meets the margins of your industry. So construction or even manufacturing can be inflated because of the margins. So one thing that I like to look at, and this is a little bit harder if we're job costing our labor, is are we 3 to 4x on our labor dollar? So in the professional services industry, that's pretty easy. Let's just say I pay somebody $20 an hour, they should be bringing in $80 to $100 an hour on their billable time. Now, not all their time's billable, so that's why there's some room in there. And then on construction companies, I like to think about the margin being that on that gross margin should be 2x our net profit. So 50% of that could be spent on overhead, if you will, and then the other 50% should be to profitability, would be very healthy for your organization if you want to get to there. And then the last thing is short-term survival versus long-term stability. So really looking at those healthy companies for tax strategy, debt reduction timing, and what does that look like when it comes to that also can play into your capital or refinancing this or repaying cash. And then what does that debt service look like? Owner wealth building is also something that is a piece of this. So they've taken a lot of risk to own the company. And what is that reward for that? So most people who are W-2 get a 401k or some type of retirement. Those people who own businesses often put all their eggs in that basket. And at the end of the day, if they don't if the timing is just off, they might get to the end of the road and not have anything to retire on. So just keeping that in mind when we think about that exit piece and then the capital structure too. So how is stability designed? It's done, and here's an example of something that you can ask yourself. So if I exited this business in 5 years, what would it need to look like and start building towards that now? I know some of you guys have, a 10-year target and a 3-year plan and really thinking about what does that stability look like in the organization. One thing that's interesting, I guess, just kind of a fun tidbit is my husband and I so we are an EOS company. So that means we run traction in our organization, which has the 10-year target, 3-year picture. And I did that, we and Chad did that exercise as well. A 10-year target, 3-year picture. Sometimes, so he is flexible, adaptable, and spontaneous, and I'm more planned and structured, which makes us like, a super couple or, irritating to each other once in a while too. But so we have a plan to become debt free in the personal side, and then we both are entrepreneurs, so on the business side, we have some plans as well there too. But what that helps us do, even in our marriage, and this certainly helps in the business perspective, is what does it look like in 3 to 5 years? What does our life look like? Because for us, our kids are all over the place, 24, 17, and 7. So our life looks different next year than it does this year with having Kylie go to college. And how do we plan for that and create stability not only in our home, but also for her? And businesses aren't that different from what our home is and what those wanting to protect and care for those people who are in our care is just another example of how this stuff and what happens in our business and what happens at home is very, very much similar. So creating that stability and what does 5 years look like is a huge piece. So where we get blindsided when we think of being like, oh my gosh, we have a fire to put out, or oh my gosh, let's react to this thing, happens when we don't address these blind spots. So growing too fast or growing without clarity is a big piece of it. Hiring before the process, so just like, oh, somebody left, we need to hire somebody, or I feel like I need somebody, let's do this. Confusing revenue with success. So making sure I see this, and I actually, yeah, you don't need to know all of the thoughts that are in my brain. I have somebody that I need to reach out to because yesterday in the comment, they talked about doubling their revenue. And when we look at it from an outsider perspective, actually, that's not probably the best choice for you because your expenses are going to triple. So therefore, you're actually going to net less. So let's have a conversation about that. So making sure that we understand where revenue is and what actually hits the bottom line. Another blind spot is avoiding hard conversations in some of the organizations that I work with. If somebody's not in the right seat on the bus and that person needs to be modified, like we need to have those conversations. One, they're feeling the strain too if they can't perform in that position. But having those is often something that would be like, I just don't know why sales won't take off in this area, and you don't have somebody who's strong in that sales position. It's not actually a blind spot. It's just a choice of avoiding hard conversations. Not defining owner compensation strategy. So if you're in a small organization, what can often give the controller some issues is when the owner just takes money out, like, ooh, there's this investment over here that I want to do, and I take out X number of dollars. So that's hard. And then that cash reserve strategy gives us small businesses a lot of let's sleep at night kind of feeling. So most stress in business is preventable, but it can only be done if we think about it ahead of time and slow down. That's the biggest thing. So if you're tired of those surprises, reaction decisions, feeling that financial anxiety, growth that feels a little chaotic, then it's time to build that operating system and just running the system, or actually, as we continue to adapt to AI, having the system run for us so that we can say, okay, what about this scenario? Or what about that scenario? It sounds easy. It sounds simple, not easy necessarily, but that's where I really think that our society is going to and our businesses are going to. And if we haven't adopted those opportunities to program and think like that, we're going to be behind the 8 ball. So again, revisiting those 5 shifts, really focusing on leading indicators, focusing on an financial operating system, having a dynamic roadmap versus a stagnant budget, that financial leadership, like what does the data say? Am I feeling, am I thinking, or do I know? Do I have the actual data? And then focusing on that long-term stability and what is the plan long term is a good piece to help you sleep at night. So you don't need more hustle. What you need is more clarity, and clarity changes everything. So when I think about when my clients come to me and they feel heavy or they feel stressed out, it often has to do that they don't actually know. They just are going off of gut feeling when it comes to managing their organization. So that's what I have for you today. If anybody has any questions, I'd welcome you to come off mute and you can ask a question and I'll do my best to answer.
No questions, but I just want to say thank you, Sarah. That was great.
Okay, thank you, Aubrey. All right. Well, thank you for joining us for this last hour. And Drew will send out the recording and some notes that come along with this. Appreciate all of your time and your connection with light, and continue to follow us and be engaged with us. So, have a great day.
Thank you, Sarah.